Good evening, everyone. I am CA Madhya, Chairman of Guntur branch of SIRC of ICAI, and I welcome you all to today's virtual webinar on analysis of penalty provision under Income Tax Act by a renowned and expert speaker, CA Banu Sekhar sir from Chennai. I am happy to inform you that this is the first seminar of our new managing committee of Guntur branch for the council year 23-24. In fact, earlier assessments used to happen physically, and then there are a chance at the discretion of an officer, penalties used to be levied. But after the introduction of faceless assessment and the use of lot of technology by the income tax department, it has become inevitable for the officers to initiate penalty proceedings for every case. So in light of this, so we thought that this would be the apt topic for and useful for every one of us. So we have chosen this topic and selected the expert speaker, CA Banu Sekhar sir. And I also would like to request Banu Sekhar sir. Sir, many terms are interchangeably used in the penalty proceedings, like concealment, under-reporting, undisclosed income, misreporting of income. So I request you to please elaborate on each term, sir, so that there will be a clear picture for the members of the profession. And also, due to non-compliance of the provisions in the Act, the SSC has to pay interest, late fee, and penalties in addition to tax. So I request my fellow professionals to bring awareness among the taxpayers so that these can be avoided. Now I request CA Gugilam Pawan Kumar to give a brief introduction of today's speaker, CA T. Banu Sekhar sir.
Good evening, everyone. T. Banu Sekhar sir had qualified as a chartered accountant in the year 1994. He had contributed articles on direct taxes and international taxation to several tax journals, including Consolidated Commercial Digest, Taxman, Tax Referencer, and the Income Tax Review of Tax Consultant Mumbai. He have argued in a number of landmark cases before various benches of income tax appellate tribunal across the country, which have resulted in establishing precedents for many common contemporary issues. Chief among such cases are Ford India Limited relating to claim of deduction for warranty expenses, Saxoff Limited before the special bench on parity between numerator and denominator in computing deduction under Section 10A, Ford Business Services Center Private Limited relating to the benefit under Section 10A, SSI Limited relating to total taxability of ESOP, Vijaya Productions Limited relating to the accrual of capital gains, Apollo Hospital Enterprises Limited relating to taxability of capital gains earned in India on sale of shares of Sri Lankan company, Reflex Industries Limited relating to allowability of write-off of investments in subsidiaries and claim of losses on account of corporate guarantee given to subsidiary as a revenue expenditure. and he had fought in many more cases. He have argued in a number of cases in various benches of the Income Tax Settlement Commission. He had ordered the following books: Handbook on Assessment Procedures under Income Tax Act 1961 and Search Assessment under Income Tax Act. He had served as visiting faculty at the Institute of Chartered Accountants of India, Institute of Company Secretaries of India, and Loyola Institute of Business Administration, and also trained various commissioners of income tax on direct taxes. He had delivered lectures and presented papers on direct taxes and international taxation at various seminars, meetings, workshops, and conferences arranged by ICAI, SIRC, and many other chambers, and several branches of regions of the ICAI. He had also elected as chairman of the Direct Tax Committee of the Hindustan Chamber of Commerce. He had served various positions of SIRC of ICAI. With this, I request the speaker of today's session to take over the session.
Thank you, sir. First of all, my sincere thanks to the Guntur branch for giving me this opportunity to be here. And before I start, I must congratulate the new team on having taken over the branch activities for the council year 23-24. My best wishes to all of you, sir. And with this, I will go straight to the subject. As the chairman of the branch put it, with the advent of faceless assessment, there seem to be a number of issues that are, that are challenges that we are facing, where, sometimes we are not able to meet and communicate with an officer in person, where we believe that if the communication had been on a personal one-to-one basis, we may have been able to convince an assessing officer. But then with the advent of technology and with the faceless assessment becoming almost a reality, and it being something which appears as something which has come to stay, we may have to continue to face this and learn to adjust ourselves to the current scenario. Now, originally assessments were faceless. Later on, penalty proceedings were also made faceless. Now, in the process of our deliberation, one aspect that the chairman pointed out was that words are being interchangeably used, like concealment, in furnishing of inaccurate particulars, etc. And he had wanted me to highlight these aspects, which I will do as I proceed. Now, the aspects relating to penalty gain a lot of significance with a number of new penalties coming into play, like the provisions of 271 AAC, 271 AAD, 271 AAE, 271 DA, and with also the introduction of section 270A and the provisions of 270 AA, which provide for immunity in certain cases. So we have literally now a new set of provisions dealing with penalty. Now, what I propose to do over the next 1.5 hours or so is to try and discuss about the new penalty provisions, particularly the income-based penalties, where number of issues have arisen and a number of amendments have happened in the last, say, about 4 years or so. Now, coming to the penalties which are leviable, the first penalty that I will deal with is 270 capital A. Now, 270 capital A, as you are aware, is applicable from assessment year 17-18. Prior to assessment year 17-18, that is up to assessment year 16-17, penalty was leviable under 271(1)(c). Now, since 270A took over from 271(1)(c), what we shall do is first to, briefly discuss the provisions of 271(1)(c) and the law that had developed in the context of 271(1)(c), so that we are able to discuss the provisions of 270 capital A in a manner which will be better for us to understand. Now, talking about 271(1)(c), you will recall that 271(1)(c) was leviable for concealment or furnishing of inaccurate particulars of income. Now, if you look at the exact language, it said concealment of particulars of income or furnishing of inaccurate particulars of income. So, in both the cases, what was required was concealment of particulars of income, not income. And similarly, when they talked about furnishing of inaccurate particulars, they said furnishing of inaccurate particulars of income. So, your concealing income or your furnishing of inaccurate income does not invite a penalty under 271(1)(c) at all. 271(1)(c) is applicable only when particulars are concealed or particulars of income are inaccurate. Now, if you go back to 271(1)(c), you will also see that the law provided that the assessing officer, the commissioner appeal, the principal commissioner or the commissioner in the course of proceedings under this act is satisfied that and then proceeded to say has concealed particulars of his income or furnished inaccurate particulars of income. So there are 4 authorities of income tax who are contemplated. 1, the AO, 2, the Commissioner of Appeal, 3, the Commissioner, and 4, the Principal Commissioner. And it made it very clear that the proceedings should be initiated in the course of proceedings under the Act. Now, if you must understand this aspect, it is very simple. For example, if a person has violated 269 SSA, acceptance of loan in a sum exceeding rupees, whatever the stipulated sum under 269 SS, there is nothing which requires that the penalty should be initiated in the course of proceedings under the Act. So even without a proceeding under the Act, penalty can be initiated. Whereas for 271(1)(c) to be initiated, it should be done in the course of proceedings. That means proceedings of assessment must be taking place, and in that proceeding, the commissioner or the assessing officer or the commissioner of appeal or the principal commissioner must be satisfied. So it can be an assessment proceeding, it can be an appellate proceeding, or it can be a revisionary proceeding under 263 or 264, where the said authorities may be satisfied that there is concealment of particulars of income or furnishing of inaccurate particulars of income. And is it that in each and every case the penalty is exigible? No, the answer is no. Now, if you look at the provisions of 271(1)(c) as they stood, it talked about a person, explanation 1 talked about a situation where a person fails to offer an explanation or offers an explanation which is found to be false, or the person offers an explanation which is not bona fide or which he is not able to substantiate is a bona fide explanation. Now, in these circumstances, it is possible that there can be a levy of penalty under 271(1)(c). Explanation 2 to 271(1)(c) is probably the most complexly worded explanation in the whole of the Income Tax Act. In fact, it contains 269 words without a full stop. Without a break in the sentence, one sentence comprising 269 words, it is what explanation 2 is all about. And what does this explanation seek to do? It seeks to provide that in a case where an assessee has had an addition to his income made in any assessment year, but for whatever reason, if as a result of that addition, no penalty has been levied for that year, and if the assessee seeks to use this amount which was added as source in a subsequent year, then penalty can be levied in that subsequent year. I will just take a couple of examples to illustrate what explanation 2 talks about. Explanation 2, for example, if there is an unexplained credit in your books of account, the assessing officer seeks to add the unexplained credit. You try to explain to him that no addition is warranted, but despite that, he seeks to add and adds this amount under section 68. However, in the course of penalty proceedings, he chooses not to levy the penalty because he finds your explanation to be bona fide. Now, in a subsequent year, supposing the assessing officer asks you for the source for certain investment or certain expenditure, and you say that the addition that you made in an earlier year under section 68 is the source, then in the year in which you offer that addition as a source, penalty can be levied, though the addition is not made in that year. Though the addition is not made in that year. So no addition will be made in that year, but penalty will be leviable in that year because you are seeking to provide or say that a particular amount added in an earlier year is a source in the current year. Likewise, take an example where you have an expenditure which you are claiming as expenditure incurred in connection with your business or profession. Now, in the course of making this explanation, you try to explain that the expenditure were genuinely incurred. The assessing officer, however, seeks to disallow this, but does not levy penalty on the basis that you are giving some explanation, which according to him is sufficient for him not to levy penalty. So technically, you are claiming you have incurred the expenditure, but still you are ending up with a disallowance. In a subsequent year, if you say the source for the investment is the addition made in an earlier year, penalty will be exigible under 271(1)(c). Explanation 3 talks of a simple situation where there is a failure to file a return within the time stipulated for completing the assessment under 153, even where a return is filed under 148 within the time allowed under 153. Right? Then you are liable for a penalty which is provided for in explanation 3. Explanation 4 deals with a situation where there is a loss or where a loss is converted into income, or in a situation where deemed income is assessed in terms of 115 JB or JC of the Act. That is minimum alternate tax or alternate minimum tax for non-corporates. Now, in such cases also, they provide that penalty is exigible. Now, basically, this was to get over the decision of the Supreme Court in Nalwa Sons, where they held that penalty may not be leviable in such cases. I don't want to get into the details of all this because, as I said, 271(1)(c) is now no longer applicable. The applicable penalty is under 270A, and our discussion is primarily on 270A. But at the same time, I am discussing 271(1)(c) for the limited purpose of understanding the provisions of 270(A). Explanation 5 is rendered redundant. Explanation 5A talks of a case where there is a search. There is a search initiated under 132, and the assessee is found to be in possession of money, bullion, jewelry, or income based on entries in the books of account, and in such cases, penalty being leviable. But the penalty under 271(1)(c), read with its explanation 5A, is not applicable for the specified assessment years. I don't want to discuss what is the specified assessment year at this point in time, because that anyway will be the subject matter of discussion later on when we come to the provisions of 271(a)(b). That leaves us with two more explanations which are quite simple. Explanation 6 provides that 143(1) adjustments will not be subject to penalty. And explanation 7 provides that if there is a TP adjustment, a transfer pricing adjustment, such transfer pricing adjustment can also be subject matter of levy of penalty. Now, quick look at the various decisions that were rendered in the context of 271(1)(c), again for a better understanding of 270. Now, first thing that we have to understand in the context of 271(1)(c), as I said earlier, It is for concealment of particulars of income or furnishing of inaccurate particulars of income. Now, please remember that these are not interchangeable terms. One is where you conceal, that means you hide information or particulars of income. The word conceal comes from a Latin word which means hide. So if you have hidden particulars of income, then 271(1)(c) can be levied for concealment of particulars of income. Furnishing of inaccurate particulars of income means that you are consciously stating something which is wrong. It is a wrong particular of income which you are giving, and that also can lead to the levy of penalty. Please note these are not interchangeable. Now, it is very important to understand these are not interchangeable, as Chairman pointed out in the beginning itself, that because there are decisions, like for example, the decision of the Karnataka High Court in Manjunatha Cotton and Spinning, the decision of the Karnataka High Court again in SSA Emerald Meadows, where SLP has been dismissed by the Supreme Court, the decision of the Madras High Court in a case called Original Kerala Jewellers, likewise the decision of the Madras High Court in Babuji Jacob, and several other decisions where the High Courts have held that if you do not point out the limb under which you are seeking to levy penalty in the show cause notice, then the penalty itself cannot be levied. Now, you will recall that we used to get a standard format, whereas you have concealed / furnished inaccurate particulars of it. Now, what the courts are saying is you must strike off what is inapplicable. If you as an officer do not strike off what is inapplicable, then the levy of penalty itself is void because the charge has not been brought to the notice of the SC. You also have the decision of the Supreme Court in a case called MacData, where the Supreme Court said that merely because you say that you are agreeing to the addition to purchase fees, there cannot be the non-levy of penalty because fees is not sold by the income tax department. In fact, they say fees is not sold by the income tax department, so you cannot purchase it from them. Going further, you have the decision of the Supreme Court in a case called Dharmendra Textile Processors, which created a lot of confusion as to in what circumstances penalty is leviable. That has subsequently been clarified by the Supreme Court in Reliance Petro Products, where the Supreme Court said that so long as there is some reasonable cause for why you did not furnish or you furnished a wrong particular of income. Am I audible, sir?
Perfect.
Yes, sir, you are audible, sir.
Yeah, because
Yes.
I have a couple of people who have.
No problem at their end, sir. No problem.
Okay. I'm sorry, I had to interrupt. But then, as I was saying a little earlier, the Supreme Court clarified in Dharmendra Textile Processors that penalty will not be levied in such cases. In fact, there are a couple of other decisions, namely the decision of the Supreme Court, old decision of the Supreme Court in a case called Dilip Shroff, and a decision of the Supreme Court in a case called Ashok Pai, where they said if the SSC has relied on an expert and taken a view given by an expert, penalty will not be leviable. You also have a classic decision of the Supreme Court, not in the context of the Income Tax Act, not in the context of the Income Tax Act, but something of far-reaching consequences. A decision of Supreme Court, which is reported in 118 ITR 326. I repeat, 118 ITR 326. It is a decision of Supreme Court in a case called Motilal Padampat Sugar Mills Limited versus the state of Uttar Pradesh. I repeat, Motilal Padampat Sugar Mills Limited versus the state of Uttar Pradesh, where the Supreme Court observed that penalty is not something which is so direct. And in fact, the Supreme Court went on to say, you cannot presume that every person knows the law. And they go on to say that it is often said that there is a presumption that every person knows the law, but they say that that is incorrect and there cannot be such a presumption. The last decision that I will refer to is the decision of Supreme Court in a case called Price Waterhouse, where the assessee had failed to show a particular income or a disallowance under 40A7 in his return of income, but the same had been shown in the tax audit report. Now the question was whether penalty is leviable, and the Supreme Court said, no, penalty is not leviable. After all, it was shown in the tax audit report, it was not shown only in the return of income. In other words, what the Supreme Court said was, it is all right, Price Waterhouse did not know income tax. Right? Price Waterhouse did not know income tax. Their tax auditors knew income tax. That is enough. They could not have been their own tax auditors in any case. So Price Waterhouse, if they can be forgiven, I think almost every citizen of this country is entitled to that benefit. Now, these were broadly the spectrum in which 271(1)(c) was there, and this is how the law had evolved in the context of 271. And then the department decided that we have understood 271(1)(c), and therefore they scrapped 271(1)(c) and brought in 270A. After all, if new confusion does not start, how do we survive? How do we survive if new confusion does not start? Maybe what the department thought or what the government thought, and this led to the removal of 271(1)(c) with effect from 2017-18 and its substitution with section 270 capital A with effect from assessment year 2017. Now let us go to 270 capital A. Now, as I said in the beginning itself, section 271(1)(c) says the assessing officer, the commissioner appeal, the principal commissioner or the commissioner in the course of proceedings is satisfied, then he may direct the levy of penalty. Now, if you read 270 capital A, it says that the assessing officer, the commissioner appeals, the principal commissioner or commissioner may during the course of proceeding direct that any person who has underreported his income shall be liable to pay penalty on the underreported income. Okay. So it does not use the words is satisfied. Now we will have to understand what is the meaning of this statement without the words is satisfied. I will not discuss this at this present moment, but I will discuss this when I come to the actual computation of penalty, which is provided for in 270 capital A(2). But then, before I proceed further, please understand that as you proceed in this section, you will understand that there is something called underreporting of income and something else, which is called underreporting as a result of misreporting. So one is underreporting of income and two is underreporting as a result of misreporting. In other words, underreporting as a result of misreporting is a subset of underreporting only. But for the sake of convenience, for the purpose of our discussion now, I will use the term underreporting as meaning only an underreporting which is not as a result of misreporting. And I will use the term misreporting to mean underreporting as a result of misreporting. Right? Please remember, I repeat, the law provides for underreporting of income and goes on to further provide for a subset in that which is called underreporting as a result of misreporting. But for the sake of easy understanding and convenience, we will call this underreporting and misreporting of income. So there are two effective circumstances in which penalty may be leviable under 270 capital A. One is for underreporting and the other is for misreporting. Now this is slightly akin to your 271(1)(c), which talks of concealment of particulars of income and to furnishing of inaccurate particulars of income. And as I said in the beginning itself, the courts have consistently held in various cases that if the limb under which penalty is sought to be levied is not made clear, then penalty is not leviable at all. I was referring to the decision of the Karnataka High Court in Manjunatha Cotton and Spinners, the Karnataka High Court in SSA Emeralds, where the SLP has been dismissed by the Supreme Court, the Madras High Court in original Kerala Jewellers, etc. Now, in my understanding, even in the context of 270 capital A, it is important for the assessing officer or the commissioner appeal or the principal commissioner or the commissioner to state whether he is seeking to initiate penalty for underreporting or for misreporting, even in the show cause notice. And in my understanding, I will go a step further, even in the order of assessment or the appellate order of the commissioner appeal or the revisionary order of the commissioner or the principal commissioner of income tax. Why I say so, I will explain in a little while. So he has to specifically, in my understanding, say even in the assessment order, I am seeking to initiate penalty separately for underreporting, or he has to say for misreporting. There may be circumstances where there might be more than one addition. Then for each addition, he has to say, for this, I am going to initiate for underreporting. For this, I am going to initiate for misreporting, and so on and so forth. Why I say this, I will come back as I proceed further. Now I go on to subsection 2 of 270 capital A. Now subsection 2 of 270 capital A has about 7 clauses. Now clause 1 would say where the income assessed is higher than the income determined in an intimation under 143(1). Right? You are said to have underreported income when your income assessed is higher than your income determined under 143(1). B, where no return of income has been filed or where a return is filed for the first time in response to a notice under 148. Then, if the income assessed is higher than the maximum amount not chargeable to tax. 3, where the income is reassessed at a higher figure than the income already assessed, then it will be the difference between the income that is earlier assessed and the income that is presently assessed, which will be the underreporting of income. These three actually, A, B, and C, form a particular class. That again I will explain. Then you have T, which says that if income is determined on the basis of MAT or AMT, that is 115 JB or JC, and if it is more than the deemed total income determined in the intimation under 143(1). Please note carefully, deemed total income is determined under 115 JB or JC. It is more than the deemed total income under 143(1). Next, where no return of income is filed and where the income is determined as deemed total income under MAT or AMT, and if it is higher than the maximum amount not chargeable to tax, then you are said to have underreported income. The last item in this category is where the deemed total income assessed in a reassessment is higher than the income already assessed or reassessed. This is the second category. The third category is where the assessed or reassessed income reduces the loss claim or the loss declared is converted into income. So the first category is income is assessed for the first time after you file return. Then the income which is higher than the 143(1) determined income is underreported income. If you are assessed for without a return, or if you are assessed after you file a return under 148 for the first time, that is, you have not earlier filed a return, then the amount that is more than the maximum amount not chargeable to tax will be the underreported income. And if you have already been assessed at a figure and you are being reassessed, the difference between the income which was originally assessed and the reassessed income is the underreported income. This is category 1. So one thing is very plain and clear. They don't want to levy penalty on the 143(1) adjustment. You will recollect explanation 6 to 271(1)(c), which specifically provided that any adjustment made under 143(1) is not subject to the levy of penalty under 271(1)(c). Now, what was there stated in legal terms, they are now trying to state in arithmetical terms. Right? So, by saying that the underreported income will be the difference between the assessed income and the 143(1) income. Right? Now I will pause here for some time. The next category is where there is a deemed income that is assessed under 115 JA or JB, and they are effectively saying that if the originally deemed income was determined under 143(1), the excess over that will be the underreported income. If originally you did not file return or file return for the first time under 148 after a return notice under 148, and if the income is determined, then the deemed total income, which is higher than the maximum amount not chargeable to tax, will be the underreported income. And they also say if your deemed total income is reassessed, then that amount which is in excess over the amount already assessed will be the underreported. More or less similar to what you saw in the first category, but the only thing is here it is they are talking of deemed income, they are talking the regular computation of total income. And the last item is where your loss is reduced or your loss is converted into income. Now let me come to the various issues that arise here. Now 270A, if you will see, unlike 271(1)(c), is not couched in a language which says is satisfied. So can one say that a variation in the income per se will lead to the levy of penalty? In my mind, the answer is no. Right? To my mind, the answer is no. That is because I understand that the provisions of 270A itself provide for an exit from the levy of penalty in certain cases. But before we get there, the various issues that arise from subsection 2 itself. Now, if you see the clause E of 270A2, it talks of a case where you don't file a return of income and the income is determined in MAT or AMT. I will take AMT as an example. When is AMT leviable? When does AMT come into play? Alternate minimum tax comes into play when you claim a benefit under 10AA or Chapter 6A. Correct? Now, once I say that you have filed, you are claiming Chapter 6A or 10AA, then you should have filed a return of income. Now, they are contemplating a situation where if you did not file return of income, but I am determining income under AMT. They can never determine income under AMT if I don't file a return of income at all. See how loosely it is drafted. Likewise, if you see, one of the items they say is where loss is reduced or loss is converted into income. Let me take a simple example for us to understand. Let us say I returned an income. I returned an income of nil, but I showed a business income of 10 lakh and set off brought forward business losses of 10 lakh, though my brought forward business loss was 25 lakhs, say. I repeat, my brought forward business loss is 25 lakhs. My current year business income is 10 lakh. I set off 10 lakh and showed nil income. The assessing officer determines the same income in 143(1). In 143(3), he determines my business loss not as the income, not as 10 lakh, but as 15 lakh. Right? He recomputes my business income of the current year, not at 10 lakh, but at 15 lakh. Now, how much brought forward loss did I have originally? I had 25 lakh. How much have I set off? 10. So he can set off one more 5 lakh.
Yeah.
Therefore, determining my total income at nil again. Yes. If he does so, there is no penalty leviable because the law requires that loss of current year should be reduced or loss of current year should be converted into income. I file nil return of income, you assess nil return of income. Now, if the numbers are just 10 lakh, 5 lakh, 15 lakh, like this, it is all right. Now, just assume 100 crores, 250 crores, and an addition of 50 crores. Brought forward loss of 250 crores, 100 crores, I am showing current year income. The assessing officer redetermines it at 220 crores. Still, my income will be nil. 120 crore addition, no penalty, because the law does not provide for it. The law does not provide for it. In fact, whenever I read these provisions of 270A, I am only reminded of one statement that my teacher used to make. He used to say that law does not work with the precision of English, and English does not work with the precision of mathematics. Right? In fact, he used to give us an example. I know this is recorded, but it is not that bad. I love my wife loves her sister. A equal to B, B equal to C, you can cancel B and B. Now, if you cancel wife and wife, what will you get? You cannot say, I love my sister-in-law. I can still continue not to love her. Right? Mathematically, if A equal to B, B equal to C, A has to be equal to C only. But that is not the way it works in English, and definitely not in law. Now, the problem arises because they seem to have made everything in an arithmetic fashion, rather than drafting it in a legal fashion. Right? This is one aspect that you need to remember. Now, I will come to the determination of the underreported income. Now, we saw when there is an underreporting of income. Now, we see how to determine the underreported income. The determination of the underreported income is very simple. Where income is assessed for the first time, the income assessed minus the 143(1), or the income assessed minus the maximum amount not chargeable to tax if no return of income has been filed. So if you have filed a return of income and if you are being assessed for the first time, the income assessed minus the income determined under 143(1). If you have not filed a return of income, then it is the income assessed minus the maximum amount not chargeable to tax. Now, in a case where you are reassessed or recomputed, then the income that is presently assessed minus the income that is earlier assessed. That this is the second category. The third category is where there is a reduction in losses or conversion of loss into income. Now, note very carefully. Where there is a reduction in losses or conversion of loss into income, then the subsection 3 says that the underreported income will be the difference between the loss claimed and the loss assessed. Be very careful. It says loss claimed and the loss assessed. Now, let us assume two scenarios. Scenario number 1, you returned a total income of say 10 lakh. I'm assuming you are a company for convenience's sake. You returned an income of 10 lakh. 143(1) proceedings were done. Income was assessed in 143(1) at say 15 lakh. Some adjustments were made to your income and it was determined at 15 lakh. Okay. Now, subsequently, your return is picked up for scrutiny and your income is assessed at 22 lakh. On what is your underreported income? Your underreported income is 22 lakhs minus 15 lakhs, which is your income determined under 143(1), or your underreported income is 7 lakh. So thereby you will see that the adjustment under 143(1) does not suffer penalty. Understood this part? Now let's look at a loss return. You returned a loss of 10 lakh. The assessing officer recomputed your loss as 5 lakh in 143(1) proceeding. Right?
Yeah.
And in the assessment, he determined your income at 2 lakh. I have already assumed you are a company. Right? You are not an individual. Because then you will say basic exemption and all that. I don't want to enter that debate for the time being. So he determined your total income at 2 lakh in 143(3) proceeding. Now, on what is penalty leviable by virtue of subsection 3? It says loss that is determined minus the loss that is claimed by the assessor. So the penalty will now be exigible not on 7 lakh, but on 12 lakh. Which means the adjustment made under 143(1) can also be subjected to a penalty. Where a loss is reduced or loss is converted into income, even your 143(1) adjustment arithmetically may be subject to penalty, right? Because the law does not provide for taking the income that was determined or the loss that was determined under 143(1). It talks about the loss claimed by the assessor, right? There seems to be a drafting lacuna here. Likewise, take a situation where you go in appeal before the commissioner appeal. When does the commissioner appeal seek to levy penalty? When there is an enhancement made by the commissioner, isn't it? You all are aware that a commissioner appeal has the power of enhancement. So in a situation where he seeks to enhance your income, he could levy a penalty under 270 capital A. Right? Now let us assume that you returned an income of 10 lakh. Your income was determined in 143(1) proceedings at 15 lakh. The assessing officer determined your income at 22 lakh, and the commissioner appeal made an enhancement of a further 8 lakh and determined your income at 30 lakh. Logically, on what should he levy penalty? He should levy penalty on 30 minus 22. Because on the difference between 22 and 15, the AO would have already levied the penalty. But the law does not talk of a case where he can determine the penalty on the basis of only his enhancement. Because he is not doing an assessment, he cannot reduce the income earlier assessed. He has to reduce it by the 143(1), in which case he will levy penalty on 30 minus 15, in which case on the 7 lakh, there will be a double levy of penalty. That is the next drafting lacuna, which probably needs to be corrected. I will quickly go on to subsections 4 and 5 of 271(1)(c). Suffice it of 270(a), I'm sorry. Suffice it to say that subsections 4 and 5 are nothing but explanation to 271(1)(c). Now you will recall that in a case where there is, I discussed about a case where there is an addition but no penalty is levied, and subsequently you take source credit, then you will be liable for penalty in the year in which you take source credit. You will find that there is a similar provision in 270 capital A also. Right? Okay. Now there is no difficulty so far. But there are two important lacunae that can be found in the application of subsections 4 and 5. Now let us assume I had an addition made in assessment year 16-17 when penalty was leviable under 271(1)(c), but penalty was not levied under 271(1)(c). In the assessment year 19-20, I take source credit for the addition made in 16-17. Can penalty be levied in the current year? The answer is no, because the provisions of subsection 4 and 5 say that penalty under 270(a) must not have been levied in an earlier year. In an earlier year, when the addition was made, there was no 270 capital A at all. Therefore, if you claimed, if an addition was made in an earlier year prior to the introduction of 270(a), but source credit is taken after introduction of 270(a), in my understanding, penalty cannot be levied at all. And the bigger problem. Now, assuming in some case penalty can be levied under 270(a), how do you determine the underreported income? Underreported income is income that is presently determined minus 143.1 or minus income already assessed. Correct? Now, in the current year, I am taking source credit for an addition made in an earlier year. Addition has been made in an earlier year. Let us assume addition is made in 17-18, but penalty is not levied under 270A in 17. In this year, I am only taking source credit. In 18-19, I am taking source credit. Right? No addition can be made in 18-19. Please understand. Because the addition has already been made in 17-18. Right? Only penalty, if at all, can be levied in 18-19. Now, for penalty to be levied, arithmetically, you have to compute the income that is presently assessed minus 143.1 or the income already assessed. The income currently assessed will be equal to 143.1 because no addition is made. Then how will you levy penalty on? So it appears that though they have carefully drafted subsections 4 and 5 into 70 capital A, arithmetically it is incapable of the levy of penalty. Because 270A penalty can be levied only if there is an addition in the current year. And you will see that there is no addition in the current year. The addition was made in an earlier year. Therefore, penalty cannot be levied in the current year at all. Right? Now, I will go on to subsection 6, which says incomes which are not said to be underreported income. Now, if you go to subsection 6, there are effectively 5 situations. Am I audible?
Secretary, please unmute, sir.
Mail should address me as a artist.
Please unmute.
I'm sorry. Now, there are 5 circumstances which are contemplated in 270A6, where they say that it will not be a situation where penalty is leviable for underreporting. What are these 5 situations?
One second. Banu Sekhar, I'll speak with the person personally. 1 second.
Yes,
In the phone number. The phone number will be on this. From
Please carry on, sir.
Yes. Now, we were discussing about the 5 situations in 270A6, which are said to be cases of where there is no underreporting of income. The first of it says the assessee has offered an explanation to the AO, Commissioner, Principal Commissioner or Commissioner, and they are satisfied that the explanation is bona fide and the assessee has disclosed all material facts to substantiate the explanation offered. This is very similar to your explanation 1 to 271 1C. The second circumstance is they say the accounts are correct and complete, but the method of income, where the method of income employed is such that the income cannot be properly deduced. 3 is where the assessee has estimated a lower amount of addition or disallowance, but that is revised by the AO. 4 is where the assessee has maintained information and documents prescribed in 92D in respect of an international transaction under Chapter 10 and has disclosed all material facts relating to transaction, and the underreported income is represented by an adjustment to the arm's length price. And the last is to say that if penalty is leviable under 271 AAB, then penalty is not leviable under 270 capital A. Now, as I said in the beginning, the first exception that is created to the levy of penalty by subsection 6 is akin to explanation 1 to 271 1C, where you offer an explanation which is bona fide and the SC has disclosed all material facts to substantiate the explanation. Now, this seems to be a little catchy because it is not enough if you give an explanation which is bona fide. If you see 271 1C, you give an explanation that is bona fide, that is enough. But here it says you must disclose all material facts substantiate the explanation. I may not have a material fact in my possession. Then what happens? I would think that even in such a case, so long as an explanation is found to be bona fide, penalty is not leviable under 270 capital A. The second exception I have failed to understand despite reading it 100 odd times. It says your accounts are correct and complete, but the income cannot be properly deduced based on your method of income, based on your method employed. If my accounts are correct and complete, I don't see why somebody cannot determine my income properly on the basis of such books. So I don't understand what they are trying to say, but this is what they are trying to do. Now, the third clause says that you have estimated a lower deduction, disallowance or addition, and the AO has increased the disallowance or the amount of addition. Now, you will recall that in the context of 271 1C, there were various High Court decisions where the High Courts had consistently held that penalty is not leviable where an estimated addition is made. Now you see the language. You must have estimated a disallowance or an addition. The AO must increase that estimate. Only then they are saying the exception will operate. So if you don't make an estimate, but the AO makes an estimated disallowance, can penalty be levied? I will answer these questions together. The next is, assessee maintains international documents for international transaction, and there is an arm's length price variation. I will not deal with this for the time being. I will deal with this when I come to subsection 8. And the last, of course, is very simple. Penalty is already levied under 271 AAB, then 270A should not be levied. We will discuss this when we come to AAB. Now, please remember, one important question is whether subsection 6 is exhaustive or illustrative. If you say that it is exhaustive in nature, excepting in these 5 categories, in all other cases, penalty will be leviable. If you say it is illustrative, then these are only indications of when penalty cannot be levied. The scope can be amplified by an AO or a commissioner or a commission repeal to determine whether penalty is leviable or not leviable. Right? In my understanding, 270A6 is illustrative and not exhaustive. The reason why I say this is, you will see that, for example, estimated disallowance. Otherwise, penalty will become leviable. Right? So, in such cases also, penalty should not be levied. Penalty cannot be automatic. Right? Penalty cannot be automatic. That is why I say it is only illustrative in nature. I will explain more about this exhaustive and illustrative when I come to subsection 9. Now, talking about the provisions of penalty, the quantum of penalty, you have the quantum of penalty being stated in subsections 7 and 8, where they say the quantum of penalty for underreporting is 50% of the tax payable, but for underreporting as a result of misreporting, it is 200% of the amount of tax payable on the underreported income. So 50% of the tax payable on the underreported income, 200% of the tax payable on the underreported income if it is misreporting of income. Next, you have subsection 9, which says what is misreporting. Please note, here they are not saying what is not misreporting. Subsection 6 says what is not underreporting. Subsection 9 says what is misreporting and divides it into 6 categories. 1, misrepresentation or suppression of facts. 2, failure to record investment in books of account. 3, claim of expenditure not substantiated by any evidence. 4, recording of a false entry in the books of account. 5, failure to record a receipt having a bearing on the total income. And 6, failure to report an international transaction or a deemed international transaction or a specified domestic transaction. Now, quickly dealing with each of these. Misreporting, misrepresentation or suppression of fact, that is to be decided on a case-to-case basis, whether you have wrongly stated a fact or suppressed a fact. B, failure to record investment in books of account. Now, again here, I have my own reservation. Now, when I fail to record an investment in the books of account, addition will be made under 69B. Failure to record an investment in the books of account will lead to an addition under 69B and consequently will lead to the levy of tax at the rates prescribed in 115 BBE. That is 60%, plus of course added by a surcharge of 25% and other surcharges. I think there is some disturbance.
Sir, yes, sir. Yes, sir. We have attended. Yeah, everyone will be unmute. Everyone will be muted now. Everyone will be muted now.
Thank you so much.
1 second, sir. 1 second.
I hope everyone does not include me, sir.
I understand, sir. Thank you. Thank you. Very interesting session, sir. Very interesting session. Thank you. Thank you.
May I proceed, sir?
Yes, sir. Yes, sir. Please.
Yes. So, failure to record an investment in the books will lead to an addition under 69B, consequently to a tax rate provided in 115 BBE, which is 60% as increased by a further surcharge of 25%. So, effectively 75% plus other surcharge, which can be up to 78.5%. Now, I don't understand how 270A will apply in such cases, because in such cases, 271 AAC should apply. 271 AAC should apply. Right? Probably they are only contemplating a situation where an addition is made in the after a search, and that too not for the specified years. Right? Next is claim of expenditure not substantiated. This again is a very tricky scenario because supposing I have self-made vouchers, will they say it is not substantiated? Recording a false entry in the books of account. I will deal with this again when I come back to a further provision in 271 AAD. Failure to report an international transaction, a deemed international transaction, or a domestic transaction. Now, if you look at this, if you distinguish this with 270A6, 270A6 talks of only an international transaction. Whereas here they are talking about deemed international transactions also, specified domestic transactions also. This is another reason why one can understand that subsection 6 is illustrative. Right? Now, what happens to 270A9? Is it illustrative or is it exhaustive? Now, here they are saying misreporting, the list is as follows. That means it is exhaustive in nature, and these alone can be a case of misreporting of income. Anything else cannot be a misreporting of income. Also remember that if an officer seeks to levy penalty under 270A for misreporting of income, he has to tell me under which clause he proposes to initiate, and in the final order has to say under which clause he is seeking to levy the penalty. Right? Under which clause he is seeking to levy the penalty. Now, this is so far as subsection 9 is concerned. I quickly go on to subsection 10, which says how to compute the tax payable on the underreported income. The tax payable on the underreported income will be if a return has not been furnished by the SSE or is furnished for the first time under 148, then the income assessed plus the maximum amount not chargeable to tax. Right? If the total income is determined under 143(1) and thereafter, if there is a redetermination of the order where there is a order where you determine the loss, then they say it should be increased by the loss originally determined. Put it very differently. Loss returned 10 lakh, determined under 143(1) is 5 lakh, but the situation is that my income assessed is, say, loss is 5 lakh, income assessed is, say, 20 lakh. Then they are saying the tax on underreported income will be the difference between the tax that is calculated on the underreported income, which is nothing but the income originally assessed minus the loss or that is presently assessed, or if it is presently an income, add the loss. And the last scenario they say will be in every other case x minus y. X being the total income determined under 143(1) and y being the total income that is assessed or reassessed. Right? Now here again, you will see that very unfortunately, subsection 10 does not deal with how to compute the tax on underreported income in a case where deemed income is computed. Well, for computing underreported income, they have said that. For computing tax on underreported income, they have not said. Again, a drafting lacuna. I will not deal with subsection 11 for the time being, because that I will deal when I come to 271 AAD. Now, this is so far as the various issues that you can look at in the context of 270A. Just one more issue, because as I said, it is arithmetically computable. You will quickly see that if there are two adjustments, one adjustment where the addition is made, but another adjustment where some income is reduced, say you return an income of 10 lakh, the assessing officer makes an addition of another 8 lakh, but also gives you an allowance of 2 lakh. Penalty can be only on 6 lakh. Right? Now 270 AA is a very simple section which talks of immunity from penalty. Now the first thing is, from a plain reading of the provisions of 270 AA, it appears that cases of misreporting will not be eligible for this immunity. But there is a debate in various professional circles where many experts feel that even where there is a misreporting of income, immunity can be granted from penalty and prosecution under 276C and CC, but that is at the discretion of the office. But if it is a case of underreporting of income, he mandatorily has to grant immunity. This is one school of thought. The other school of thought is it is only for underreporting, not for misreporting. I belong to the second school of thought. I would say that the immunity can be granted only in a case of underreporting. If it is misreporting, immunity cannot be granted. Now, let's have a quick look at the provisions of 270 AA. What are the requirements? The requirements are: 1, it should not be a case falling under subsection 9 of 270A. That is, it should not be misreporting. B, it should be a case where the assessee has paid the tax or demanded within the time allowed in the notice of demand. And 3, the assessee should not have filed an appeal against the above order. Very important to remember, against the above order is the language used. That is the order under subsection 1 for which you are seeking immunity. There is also a requirement that you must make an application in form number 68 before the assessing officer within 1 month from the end of the month in which the order under 143.3 or 143.3 read with 147 is received by the assessee. Please note that there is no provision to condone the delay in filing form 68. If you don't file the form 68 within the time that is stipulated, that is 1 month from the end of the month in which the order under 143.3 or 143.3 read with 147 is received, then you are not entitled to avail of the immunity. Now, what will be the immunity that will be granted? The immunity will be granted under 270 capital A, 276C and 276CC. 276C is for willful attempt to evade a prosecution. 276CC is prosecution for non-furnishing of a return of income. Now, there are various aspects that arise as a result of 270 AA. Now, the foremost thing that you have to remember is 270 capital A is for underreporting alone. Sorry, 270 AA is for underreporting alone. Once I say this, it is very clear that the officer must state in the order of assessment whether the addition is for underreporting or misreporting. Only then I can decide whether to go or not to go. For 270 AA immunity. Right? That is why I said he must state in the order of assessment for what he is going to levy the penalty. Please also note that 270 AA says that you should not appeal against the order. Now, it looks very simple, but then you must understand that in an order of assessment, it is not one addition that may be made, but more than one. The officer may initiate penalty under 270A for one addition and 270A for misreporting on another addition. I may want to go for immunity, but can I? You can, but if you do, you cannot file an appeal against the entire order. You cannot file an appeal against the entire order. For misreporting, I will not grant you the immunity. I will grant you only for the underreporting part. At the same time, you lose your right of appeal on the order, not on the issue. They have not said the issue that for which immunity is granted should not be appealed. The order should not be made subject matter. That again is another impediment which may not have been intended. The third, if there is a best judgment assessment made under 144, can you claim the immunity? Please see, the language used is the order should be passed under 143.3 or 143.3 read with 147. If it is a best judgment assessment under 144, you don't get a right to go for an immunity at all. Right? Now, what if my immunity is rejected? Can I go in appeal after that? You can. The provisions of 246A have been correspondingly amended to say within 1 month that the time frame taken from the day on which you made the application to the date on which it is rejected will be excluded for the purpose of computing, right? Will be excluded for the purpose of computing the time limit for filing the appeal, right? So you automatically have an extension and consequently you can file an appeal. The other issues that arise as a result of 270 AAR, you will see that the CIT can also, CIT or the CIT appeal can also levy a penalty. So when they make an addition in 263 proceedings or in appellate proceedings by the Commissioner of Appeal, he has to say, is it underreporting or misreporting? Because only then I can decide. Because I will not go to the Commissioner or the Commissioner of Appeal for immunity. I will go to the AO for immunity. That's how the law provides. So I have to see whether I must go or not go. Likewise, you will see that the law specifically provides that you should not go in appeal to the Commissioner of Appeal. What if it is a case where enhancement is made by the Commissioner of Appeal? I can go to the tribunal and also ask for immunity because the law prohibits me only from going in appeal to Commissioner of Appeal. If the Commissioner of Appeal makes an enhancement or the Commissioner makes an enhancement, I don't go to the Commissioner of Appeal, I go to the tribunal. That is not prohibited. So where there is a direct appeal, likewise where there are DRP cases, where there are transfer pricing or international foreign company cases, where you go to the DRP, you can from the DRP's order and after the AO implements it, go to the tribunal and also go for immunity. There is no prohibition. The next most crucial question. The AO in the order of assessment says it is a case of misreporting. I go for an immunity. Can he, in the course of the immunity proceedings, say, okay, I now correct my view. This is not a misreporting, but only an underreporting. Therefore, I will grant it. There is no answer to this question. Likewise, let us assume an officer initiates penalty and levies penalty for misreporting. You go to the Commissioner of Appeal and the Commissioner of Appeal says, no, this is not a case of misreporting, this is a case of underreporting. Now what happens? I have lost my right to go for an immunity. Because to go for an immunity, you must pay the tax within the time allowed in the notice of demand and make the application within 1 month from the end of the month in which the order is received. Order of assessment is received. So if in appeal, the Commissioner of Appeal determines the penalty not to be as a result of misreporting, but only to be underreporting, your right to go for immunity is lost. They don't seem to have made a provision for that. Now, one more lesson that we have to learn is be very careful. In every case where a penalty is levied for misreporting, make it clear in your grounds of appeal that if the assessing officer has not invoked a particular clause or 270A9, state that the failure to invoke a particular clause in the show cause notice and in the order of penalty will invalidate the levy of penalty. Also raise a very important ground saying that without prejudice to all your other submissions, the penalty, if at all, is imposable only for underreporting. Why I say this is, for misreporting, it is 200%. Supposing you are not able to convince the commissioner that there is no case for levy, you may be able to convince him that it is not a case of misreporting, it is a case of underreporting, in which your case, your penalty comes down to 1/4. You can always travel to the tribunal and argue that even underreporting will not come. Right? Now, what I will do is, for the rest of the time, I'll quickly deal with the other provision. 271 AAB is only for the specified previous years, where also note one more point for 270 AA, the prohibition is for going in appeal, the commissioner appeal. If you want to file a 264 before the commissioner, administrative commissioner or principal commissioner, there is no bar. So you can go under 264 and also apply for immunity under 270 AA. Right? The next is AAB, as I was saying. This is only for the specified previous years. That is for the previous year which has not ended on the date of search, and also for the previous year immediately preceding the previous year of search, where the due date for filing return of income has not expired, then penalty is leviable under 270 AAB. Interestingly, 270 AAB only talks of the AO or the commissioner appeal. The principal commissioner and the commissioner, if they invoke 273, 263, are precluded from levy of penalty under 271 AAB. For what reasons, I don't know, but they apparently have made a drafting mistake. Right? Now, how is a penalty to be levied? If you have in a statement recorded under 132(4) specified the manner in which you earned the income, substantiated the manner in which you earned the income, the undisclosed income, paid the tax and interest on the undisclosed income, and furnished the return within the time that is specified for filing the return of income, then your penalty is 30% of the undisclosed income. Otherwise, it is 60% of the undisclosed income. Very quickly, to deal with some of the issues on 271 AAB, remember that only the searched person can be subjected to AAB. A person who is not searched, connected persons, penalty is leviable only under 270A or 271(1)(c). This is point number one. Point number two, as I already said, only the AO or commissioner appeal can invoke this penalty provision. Principal commissioners and commissioners cannot invoke this provision. Right? Point number three that you will remember is that if a question is not posed as to how you earned the income, the manner of earning the income, then also you can get the benefit of 30% penalty as against 60% penalty, for which you have a decision of the Bombay High Court, which is reported in 307 CTR 700. Right? These are some of the broad aspects that I thought I should tell you in the context of AAB. Now, coming to AAC, as you are aware, wherever an addition is made under 271, wherever an addition is made under section 68 to 69D, unexplained credit, unexplained investment, unexplained expenditure, or hundi, then 271 AAC is applicable if the AO makes an addition. So what is the penalty that is imposable? The penalty that is imposable is 10% of the tax. What is the tax? The tax is 60%. Right? Please note that the surcharge is not to be added for this purpose. It is 10% of the tax. Again, if you see 271 AAC only talks of the power of the AO, the power to the AO and the commissioner. The principal commissioner and commissioner are precluded from the levy of this penalty. In fact, in AAB, AAC, this aspect of CIT appeal was added only with effect from 1/4/22. Prior to that, even the CIT appeal could not levy the penalty. Now, I will go on quickly to the provisions of 271 AAD. 271 AAD is a fairly new provision which was inserted by the from the assessment year 2021. Friends, I missed one point in the context of AAC and AAB. One thing you have to remember is that if penalty is initiated under one provision, it has to be levied under the same provision. Now, we have seen a number of cases where the AO initiates 271 AAB, but levies under 271 C, 1C or 270A because he realizes it is not the specified year. That cannot be done. Or vice versa. It cannot be done. Once you issue me a notice under a particular section, the levy has to be under that section, otherwise you drop it. Now going on to AAD. AAD can be one of the most dangerous provisions. But before I go on to explain 271 AAD, there is, as I said, this was inserted from assessment year 2021, and there is a memorandum explaining the Finance Bill 2020. I am not reading the whole of the memorandum in relation to AAD, but friends, I would urge you to read it. Right? It says, in the recent past, after the launch of GST, several cases of fraudulent ITC claims have been caught by the GST authorities. In these cases, fake invoices are obtained by suppliers registered under GST to fraudulently claim ITC and reduce the GST liability. And they go on to explain and say that in such cases, we want to levy penalty. Now, the memorandum only talks of cases where there is a fraudulent invoice with a view to take fraudulent ITC, input tax credit. But if you look at the language of AAD, that is not the way it is. It says, where in the course of any proceeding, I'm referring to 271 AAD 1. It says, where in the course of any proceeding, it is found that books of account maintained by any person, there is a false entry or a omission of an entry which is relevant for computation of total income of such person to evade tax liability. So there are two things. A false entry or omission of an entry. When it should be in the course of proceedings. As I explained, that means it should be in the course of assessment proceedings. Please note, for whatever reasons, AAD gives the power only to the AO. CIT, PCIT, nobody can levy AAD. Commissioner appeal, nobody can. Only AO can. Right? This is important. False entry or omission of an entry, and then they say, which is relevant for computation of total income of such person to evade tax liability. So, questions that are begging, false entry or omission of entry, no problem. To evade tax liability. Now, is this circumscribing only omission of an entry, or is it circumscribing a false entry also? In my understanding, it is circumscribing a false entry also, not merely a omission of an entry. Only if the entry which is made is with a view to evade liability, then penalty can be levied. Right? Now, 271 AAD also has a subsection 2, which says that the penalty may be levied on any person who causes the person to make the false entry. So, let us assume A is giving a false entry to B, then penalty can be levied on A, penalty can be levied on B also. Right? Penalty can be levied on B also. Now, what if I am a broker bringing A and B together for a false entry? I am C. In my understanding, A can be levied a penalty, B can be levied a penalty, but the person who brought them together, that is this person C, cannot be levied a penalty under 271 AAD. A third party cannot be levied penalty under 271. Now, there is already a query. That query is there in my mind also. I will answer that as I proceed. Now, what is a false entry? They have defined a false entry. A false entry is a forged or falsified document, such as a false invoice, false piece of documentary evidence. Invoice in respect of supply or receipt of goods or services or both, without actual supply of goods or services. Invoice in respect of supply or receipt of goods or services or both from a person who does not exist. Please remember that this is an inclusive definition. It is not exhaustive. What more can be brought in? We have to see, because this definition is so wide. And also remember, it does not simply use the word false entry. It also says intention to use, includes use or intention to use. This is very dangerous. See, let's assume I have an invoice which I have taken from you and kept it. There is a search in my premises. I have not used the invoice. Can penalty be levied? There is no evasion of taxes. Can penalty be levied? I got the invoice, kept it with me, but I didn't use it at all. Because they are using the term intention to use. Personally, I would think that penalty should not be leviable in such case. Right? Because the intention to use cannot be a crime. Use only can be the crime. Now that leads me to the question which a querist has already posed. Can 271 AAD and AAB be applied together? Now, for that matter, why restrict it to AAB? You can add 271 AAD and or AAB and 270A. Now go to 270A. 270A subsection 11 states that no addition or disallowance shall be liable for penalty under this section if penalty is levied under any other section. Right? Now that means that I will not levy penalty on you under AA, under 270A if AAD is levied for the same offense, because a false entry can result in your income being increased. Right? So it may come under both. So subsection 11 very clearly says I will not levy if I levy under any other provision. So one can comfortably conclude that no penalty under A will be levied, 270A will be levied if AAD is levied. But on the other hand, if 271 AAB is to be levied, because it is specified here, then can both be levied. There is no exclusion in 271 AAB. That is the querist, the point the querist is raising. In my view, for the same offense, two penalties cannot be levied. The officer has to choose AAB or AAD and levy only one of these. Right? The next is 271 AAE, which is a very important amendment made by the Finance Act 2022 with effect from assessment year 23-24. Suffice it to say that from 23-24, 273 AAE can be levied on a case where there is a violation of 13(1)(c) or 1023(c), the 21st proviso by a trust or institution. It's a very simple thing. If a benefit is derived by the person specified in 13(3), that is the founder, the author, the trustee, etc., then the benefit that is derived will be subject to penalty at 100% if it is noticed for the first time, and second and subsequent times at 200% of such amount of benefit derived by the persons specified. Now, interestingly, you may see that here the CIT appeals is not included. Principal commissioner is not included, commissioner is not included. You will also see that 271 AAE does not say that penalty will not be levied if there is reasonable cause. Nor is 271 AAE finding place in 273B, which talks of reasonable cause. Does this mean the penalty is automatic? In my view, no. No penalty can be automatic. Because if it is automatic, it is bound to be struck down. How we can get over this lack of proper drafting is to say the language is the AO may direct. It doesn't say the AO shall direct. So he still has a discretion not to levy the penalty if he so wishes. Right? Now, one point that I will mention, not directly on the provision of 271 AAE, please note that there are two decisions. One is the Jaipur bench of the tribunal. Jaipur bench of the tribunal in 119 taxman.com, and the other is the Bombay High Court in 101 taxman.com 247. Both of these decisions, the tribunal and the High Court have held that 13(1)(c) violation, tax is leviable only on the amount of deviation, not on the whole of the surplus. Assing officers predominantly have been taking a view, it will be on the surplus or the deviation, whichever is lesser. Right? The Bombay High Court and the Jaipur Tribunal say it will be on the deviation. Right? And not on, it is not as though a trust will completely lose the exemption. Balance, which is not the deviation, will be entitled to the exemption. Of course, I will probably pause here. And if there are any questions, I will take them. But before I pause, I think I must once again thank the organizers for giving me this opportunity to read the provisions again thoroughly and come up with various issues. And further, before I must pause, you will have to bear with me because these are new provisions and not yet tested in the tribunals on the court. Number of issues have arisen. Number of issues are being urged and argued before various appellate fora. Right? And I have only tried to highlight the issues and try to express my views. I might be wrong. In fact, I still remember when I started reading law, I also read a book of Lord Denning in a book which is titled The Discipline of Law. In that he says, note the words carefully, he says, seek to make your opinions clear at all costs. For your client comes to seek your clarifications and not to take your doubts with him. So he says, you seek to make it clear. The client is coming to get a clear opinion from you, not to carry the doubts that you have with you. And then he does not stop. He says, I might be wrong and sometimes am, but I am never in doubt. So I have followed that principle only. I might be wrong, but I have not been in doubt about what I said. I can stand corrected. Thank you all, friends, for a very patient hearing, and thank you, organizers, for giving me this opportunity.
Arthamaja. Sir, if any case 264 has been rejected by the PCIT, can we go for tribunal?
Sir, if a 264 is rejected, there is no right of appeal. The right of appeal is not there. 253 does not provide for an appeal against a rejection under 264. You will have to file a writ petition before the High Court, sir.
Then we can go for CIT appeals, no, sir. Revert back to CIT appeals. Can we go?
Sir, there is, see, basically what happens is, if you see 264 says that you should not have filed an appeal against the order. The Supreme Court, in a case called Hindustan Aeronautics, has held that if you file an appeal for that order, you are precluded from going under 264. But there is another interesting decision of the Madras High Court in a case called D. Lakshmi Narayanapati. D. Lakshmi Narayanapati, where the Madras High Court says that if a 264 is rejected, you can still come back to appeal. But of course, you have to remember that you have to file a condemnation because your time for filing appeal would have expired.
What the thing is happened, sir, 264, they have been rejected on a case where the revenue has been lost the case in Supreme Court SLP, sir. Then I revert back to the CIT and report that SLP case and filed it against CIT appeals. Whether I may win or not,
I think you have a very good case, sir. Please also refer to the decision of the Madras High Court in D. Lakshmi Narayanapati, where the Madras High Court says such an appeal is permissible.
Thank you, sir. Thank you.
I think there is one more query, whether 271 DA can be levied for the specified year in such cases. I think I've already answered this. It can be levied in such cases for the specified year. There is no prohibition. But if AAD is levied, then 271 AAB cannot be levied, because the question is on 271 DA. I'm sorry. 271 DA, whether it can be levied for the specified year. In my view, once 271 AAB is levied, DA cannot be levied, or vice versa. Likewise, if 270A is levied, then 271 DA cannot be levied, because the offense is one and the same.
Hope everyone has. Yes, sir, there is some more question. Okay, it's not a question actually. Sir, Namaste. This is Bharadwaj, Chartered Accountant, Treasurer of Guntur branch. Hope you are able to listen me, sir.
Yes, sir.
Sir, very much thankful for your knowledgeable presentation. We are very much delighted, enlightened with subject. And personally, I felt three were the master strokes in your subject, which were one was Motilal case law, and second one was Pricewaterhouse, The third one was the time limit, which is available after the rejection to go for the appeal, after rejection of immunity to go for the appeal. Those three things were really advantageous to our profession. Very much thankful for your time, sir. Everyone is sending best wishes and happy messages, stating that it was a very good session and we need him more and more. And with this, I'm requesting you, please grant us time whenever we are coming back to you. Very knowledgeable session, sir. Thank you, sir. Thank you. Thanks a lot.
I'll definitely try to honor every request from your side. In fact,
Thank you, sir.
not just virtually, but physically too. If time permits, I will definitely be there with all of you, because as you are aware, almost every one of you is personally known to me as a friend.
Yes,
So I would
sir.
love
Thank
to
you,
be there with all of you. Thank you
Thank
very
you.
much.
Thank you very
It
much.
will be a big boon to us, sir. Big boon to us if you accept a personal request. Thank you.
Thank you, sir. Thank you.
Thank you, sir. Namaste. Namaste.